a banker for much of his life, and that a lot of the work he's done is with what are called bankers' banks, the banks that provide services to the banks that we all think of when we think of banks. And I believe that he is semi-retired and really becoming a key resource to us at Friends of the Public Bank East Bay. And that's what I have to say.
Well, thank you. Let's just kind of share a screen, which it's allowing me to do. Thank you, Zoe. So yeah, that intro is interesting. You said a few things that could be good or could be not so good, depending on the day of the week. But thank you, Debbie. I appreciate that that welcome. I'm going to go through a deck. By all means, just interrupt or raise questions or whatever, because I'm looking at the deck. I can't see you all, so I'm not going to see raised hands or anything. But I'm fine with interruptions. I will occasionally, though, stop and ask if there are any questions up to that point, because making this interactive obviously would be helpful. Banking's an interesting thing. It's like so many things that at its heart, it's very simple. And then you start to see the way it works out in practice, and there's layer upon layer upon layer of complexity that starts to make it feel very messy, complex, difficult to understand. It has its jargon, which I still find bewildering in many cases, and the jargon seems to change every day as well. And of course, the point of jargon is to enable the uninitiated to feel totally inferior, and to feel like they don't know anything, because the cognoscenti know everything and like to feel superior. I will hopefully be able to demystify a little bit of jargon here, but I'm not going to use very much on the whole. So the idea today really is just to talk about what the basics of banking are, what banks do. By banks, I mean specifically commercial banks. I'm not going to go into investment banking at all. I'm talking about the kind of banking you and I do on a regular everyday basis, and the businesses that we're associated with do on a regular basis. So, but this is going to be from a bank's perspective. So I'm going to talk about, first of all, one of the things I was specifically asked to address is what is fractional reserve banking. There's one of those great jargon terms that you'll never imagine what it means just by trying to figure it out. It's actually very straightforward. Then I'll look at where banks get their money from. How do they make income? And then how do they spend that income? I'm actually going to show you, I'm not going to spend a lot of time on them. I'm going to show you kind of sample income statements or profit and loss statement and a sample balance sheet for a bank, because that'll allow me to talk about a few concepts around what banking is. We'll then talk a bit more about lending, because most banks, and particularly smaller banks, that's primarily what they do, is they make loans, and you'll see how that is. Then where do banks get their money from to fund the loans? Who are the major stakeholders for banks? Because banks have many masters and they have to serve those different constituencies, sometimes with conflicts. That'll be very relevant when we're looking at public banking. And then lastly, just a short thing on the types of bank in the US. If there's anything you were hoping I was going to cover that isn't in there, then just keep track of it. And if we've got time afterwards, I'll take a shot at it. Fractional reserve banking. And this is at the core of commercial banking. It's what distinguishes banking from things like loan funds and fintechs and microfinance and so on. The basic idea is that a bank can look after money for its customers in the form of deposits, but it doesn't have to hang on to them all. It only has to hang on to a percentage. Let's call it 10%. It's sort of around that. It depends on all sorts of things, actually. But let's say 10%. It receives, in this example, $100, but it can lend $90 of that out. And so that $90 gets used by a borrower in various ways. It gets spent or it gets deposited into another bank or even to the same bank. And then 90% of that can be used. So another $81 gets lent out by this bank and so on. And it's when people say that banks create money, that's generally what they mean. It's not quite the best way of putting it, but that's the idea of fractional reserve banking. It stimulates economies. It allows for the movement of money in ways that facilitate commerce, that facilitate businesses, retail spending, that kind of thing. And the key principle is this idea that when a bank receives deposits, it's allowed to lend them out, or at least most of the deposit. Banks make money through lending, and they make money particularly because the interest rates they charge when they lend are higher than the interest rates that they pay when people deposit money with them. We'll come to that a little bit more shortly. So this Investopedia definition isn't bad. Fractional reserve banking is a system in which only a fraction of bank deposits are backed by actual cash on hand and available for withdrawal. It's done to theoretically expand the economy, which it does, by freeing capital for lending. Now, there are two potential issues with this. These issues drive a number of nuances in how banks work. First of all, what happens if you've got $200,000 or $200 million deposited in a bank, and every depositor turns up the bank and says, I want my money back right now. And that's exactly what happened in the Great Wall Street crash, or right after the Great Wall Street crash. And it happened in Britain as well, which is where I grew up. The run on banks caused enormous problems, and the banks couldn't actually come up with the money. Because the fact is, if it happened today and everybody turned up at their bank branch and said, okay, I want all my money out, the banks would run out of money very quickly. It doesn't happen because the economy depends on this money continuing to move around. And there are some ways of dealing with that. The other thing is the banks lending out money to borrowers. What happens if the borrowers all default on their loans? Then the money that got deposited isn't available for the bank to pay back even at a reasonable time in the future. So first of all, not all deposits can be lent out, and that's the first thing. The second thing is some deposits can be insured. And so there's a big bank insurance fund that banks draw on, so that the first $250,000 of any depositor's funds are insured. And then in addition to that, actually, there are guarantees in place or for public deposits, collateralization, and we'll end up talking about that in another session probably. And a whole range of remedies. And then the third thing is in terms of making sure that borrowers don't all default on loans, is loan underwriting, so-called, and we'll talk about that a bit later. And then very careful oversight by, in particular, the organization that insures deposits, the Federal Deposit Insurance Corporation, which is a federal agency. It's part of the US Treasury. And the FDIC monitors how banks work and makes sure that they have safe banking practices, they manage risk appropriately, and so on. The money that banks keep that needs to be available immediately in case of a run on deposits is often actually deposited with the Federal Reserve, and the Fed funds rate is what they get paid back, which right now is nothing, basically. Pretty much like the interest rate you get on your savings accounts at banks, which is 0.01% or something in most cases. Banks can also borrow from the Federal Reserve in emergency circumstances. This isn't a long-term thing, and it's not intended for long-term use. I've heard this question come up before. Borrowing at the window isn't the way in which you get more money to be able to lend out. That's not an option. But it is a way that you deal with short-term liquidity problems. If an individual bank gets a run, for example, on deposits, which can happen, then they have access to the federal discount window to get some help. So the whole point of that is not necessarily to understand the mechanics of how any of that works, but to realize that although it sounds dangerous to say a bank only has 10% on hand of the deposits that have been made to it, there are actually a lot of controls and safety mechanisms that make that safer than it sounds. So that essentially is what fractional reserve banking is. Before I move on, any questions on that? It may become clearer in a little while. But...
We have a question in the chat that asks, how long is this window, this borrowing window?
Usually, mostly it's kind of overnight activity. It can be a bit longer than that, but it's very short-term borrowing. And it's for, it's for particular purposes. It's for the purpose of liquidity specifically. It's not useful for anything other than liquidity, is my understanding anyway. Good question. Let's talk about where banks get their money from. So I put this, I'm actually, right, I'm freeing up the rest of my screen. So I put a pie chart, this pie chart out here that I got from somewhere. This varies from bank to bank. So this is an example of a bank, and it's a large foreign money center bank, but it's not untypical. This is Deutsche Bank. But the large banks in particular look very much like this. And you'll see even for the largest banks, most of the money comes from what is called net interest income. And we'll come to that in a moment. But generally, net interest income is the difference between what the bank charges to its borrowers and what the bank has to pay for the funds that it uses to lend out. So it may have a cost of funds, so-called, and I'll define that a bit later, of 2%, and it lends out at 6%. And so it has what's called a net interest margin of 4%. And that 4% is what makes most of the revenue for the bank. Now, they have to spend that on all sorts of things, of course. We'll come to that in a moment. But other revenues, service fees, certainly, which include also loan-related fees, like origination fees. There are various kinds of those. Servicing fees in the case of commercial loans, and so on. They make money from asset management or playing in capital markets. And this is truer of the big banks than it is of the smaller banks. Mortgages, just regular real estate mortgages. For a big bank, they're a relatively small portion. Generally, I would have included that in net interest income and service charges. It's only broken out just for the purpose of this charge. Again, loan fees that I would lump into service charges. And there are various other things. Service charges also cover fees for things like payments, account management fees, special reporting, that kind of thing. So, so loans account for, depending on the kind of bank, 60 to 80% of the bank's revenues. Absolutely critical for all kinds of banks. And the smaller the banks, particularly for community banks, loans are a bigger and bigger percentage. And I've seen 85, even 90% of revenue be loan related. And so that it's made from the fact that the income we get from interest is greater than the interest we pay. And then fees related to originations and servicing, and late fees. Depending on the kind of lending, that actually can bring in quite a bit of money. Secondly, transaction fees. So this includes account and service fees, which are sometimes charged, sometimes not. And then per transaction fees. Banks that do a lot of payments actually make a lot of money from payments. But it's a very specialist environment as well. The third thing is they take on risk on behalf of customers. And this is the bigger banks in particular. So for example, a big commercial transaction in which a customer wants to make a foreign payment, for example, sometime in the future. So they know that in the future, they're going to have to pay €1 million. And they're going to pay it out of their dollar account. They're concerned that the exchange rate in 3 months' time may be less favorable than it is today. So they want to lock in today's rate. And the bank takes on the risk of that reduction, or of course, the benefit of an increase in the exchange rate. And they charge a fee for that. And there are all sorts of different kinds of taking on risk that banks do. And then lastly, banks also, they have funds themselves. They do their own investing. They do their own trading. They have access to all the markets. And again, I'm talking particularly about bigger banks. And sometimes they make quite a bit of money on this. They used to make a lot more than they do today. Regulations recently have really curtailed the trading on their own account because some banks got it really badly wrong. And that created risk for their customers and for the system. So those are the main sources of revenue, all sorts of other things. As an example, even related to lending, if a bank makes a commercial real estate loan, so it lends money on, for example, a big multifamily residential building, and the borrower defaults, the bank takes possession of that building. It may well be able to sell it for a lot more than the outstanding debt. In the case of a commercial loan, the bank will benefit from that. In case of a residential loan, not so much, because there are some regulations that protect residential borrowers. But in commercial loans, they can make money. So there's lots of other ways they can make money, but these are the main ones. And especially when we think about smaller banks, these are the big things.
We have 3 questions in the chat.
Okay.
The first one is it true that retail banks make a lot of money for bounced check fees and lack of overdraft protection?
Yes, that's a great question. Yes, it is true. It depends what you mean by lots of money. I wouldn't say it's a large percentage of their revenue. It is a lot in terms of the impact on customers. And so, consumers who struggle, for example, with managing their cash flow and lose sight of the fact they've got outstanding checks that they forgot they've got, and that causes an overdraft. That can get very expensive. And banks aren't always very responsible about helping consumers to manage their personal finances. There's a trend toward providing better tools that will also reduce overdraft fees. Bounce checks, it's the exact same thing. It really all has to do with consumers and small businesses being able to manage their cash flow. And banks have to do a much better job at providing the tools they need.
The second question is, are fees subject to regulation?
They're subject to regulation in terms of sort of fair lending rules and things like that. But I don't think that there are regulatory limits on what those fees can be. Competition is intended to address that. The problem is that it's sometimes not obvious what the fees are going to be. So what has been changing in regulations is disclosure of fees. And more, there's a move toward those disclosures being very clear. And I'll give you an example. If you make a foreign currency payment, there are all sorts of fees that go with that. It used to be that you'd make a payment thinking you were paying thinking I'm paying £1,000 to my daughter, for example, in England. And it turns out then that not only have I been hit with this fee and that fee, and the foreign exchange rate that I was given was terrible, and then my daughter had to pay a fee to credit to her account, and I had no idea of any of that. All those pieces still exist, but before I actually approve the payment, I get told what all of them are going to be, and I can make a decision. And I think that's really the direction that we're seeing in how regulation's working. And then the assumption is, if I don't like that, I'll find a different way of making the payment, which now increasingly I can do.
And the last question is, do community banks do that much of their own investments and trading?
No, they don't do very much. The main thing is they will sometimes sell off portions of their loan portfolio. And there's a number of reasons for that, help them manage their balance sheets, but they're not doing investment banking activity, not even the biggest ones to my knowledge, and certainly not smaller community banks.
Thank you.
Okay. So major expenses. I've already talked about one of them, interest expense. And the biggest expense, though, for any kind of bank is people. And people in branches. Branches, of course, have a lot of other costs associated with them, premises and either rent or property ownership expenses. But there's more to banks than the branches. There's also a huge back office staff necessary to take care of all the loan management, all the regulatory requirements, take care of things like payments, account management, customer service, which you might have experienced isn't always as good as you'd like it to be, but it still costs a lot. And they often have to use consultants as well, who get very expensive. Admittedly, I was a bank consultant, but not as expensive as some of them are. So people in general cost a great deal. Risk and regulatory costs are increasingly high. They've gone higher and higher as a percentage of total expense over the past 20, 30 years. First of all, banks, of course, if they make a loan that doesn't get paid back, it costs them money. If they've got really good collateral, they may be able to recover that. Often that costs them more than they get back because managing collateral in itself is very expensive. We'll come to that a bit later. They also, where they're taking risk on behalf of customers, they have to absorb any losses they get there. But the big fees and licenses are very expensive, especially for larger banks. And then insurance against all sorts of different kinds of risk. I think the biggest one, though, that I didn't list there is regulatory compliance. And there's a huge staffing cost. So under people, when I mentioned head office, for example, you've heard about anti-money laundering regulations. The compliance requirements for larger banks especially are absolutely horrendous when it comes to monitoring payments and other financial activities that go through the bank. The expectations on banks are very high, and in some cases unrealistically high. And also, if they don't get it right, the fines are absolutely massive. You've seen, they've made the front pages sometimes, multi-billion-dollar fines for banks that haven't got their compliance right. And they genuinely haven't got it right. They probably deserved everything they got. But that's a big part of the expense. And then carrying out transactions. So payments, for example, when a bank makes a payment, it has to make payments to other banks. It has to pay fees to other banks, whether it's credit card or ACH or wire transfer, whatever the payment type. There's always multiple banks involved. There's often lots of intermediary players, and they all want their piece. And that's why credit cards cost so much, for example, credit card transactions. So businesses pay 2 to 3% for taking credit cards, and that gets shared out among about half a dozen different players, including their bank and their customer's bank. Technology is a very big expense. It runs typically for a traditional commercial bank, it runs in the sort of 10 to 15% of total expense range. So it's a very big one. For banks that are moving more away from brick and mortar and more into digital financial services, it's pushing up toward 20, even 25%, because staffing is going down, technology costs are going up. So this is absolutely huge. Core banking is sort of as it sounds. It's where the deposit accounts get managed, where the loans get managed. It's all of the internals, all of the financial accounting the bank does. Its general ledger, all of its reporting, its compliance, all of that kind of stuff. And then all the things they do to provide mobile banking and web banking and phone banking and so on. There's a lot of technology involved in those, increasingly sophisticated and increasingly complex and expensive. And then on the back end, analysis and reporting actually also is more and more critical. This is something the big banks do very badly, by the way. They just fell so far behind in the way they use data. And that's one of the reasons that fintech companies are taking a lot of customer base from them, because they can use their data much better. Another big cost for traditional banks is fixed assets, so buildings and equipment. Computer equipment's part of that. More and more banks are leasing computer space through cloud computing and the like, but and more they're moving away from branches. Branches are being closed all over the place. But even so, ATMs and other very expensive equipment, check processing equipment is horrifically expensive, and so on. Sales and marketing, this is something you kind of wish they didn't spend so much on, because they drive us crazy. But that's the only way they can get customers. And then the last thing, which is a cost, it appears as a cost, although it doesn't appear on their profit and loss statement, is the cost of capital. Any capital they get has a cost associated with it. So if they can't use it because it's regulatory capital they have to deposit at the Federal Reserve or something similar, it's really not earning anything. And so essentially it costs them more to get than they're able to achieve from it. That's the 10% or so that they can't use. Do you have any questions on expenses? Okay. All right, here's what a sample income statement looks like. Now, this is a very high level summary income statement, and it's for a large bank. This also may be Deutsche Bank, I'm not sure. So it's all in millions of euros. It doesn't matter what the scale is. They're all kind of similar to this. And if you ever look at your bank's financial statements, for example, in their annual report, this is taken out of the annual report, in fact. This is the kind of thing you'll see. And it shows really what I just went through. So where does the money come from, leading up to a total revenue line? And you can see that 3.3, and it's actually 3.3 billion, but let's call it that, 3.3 billion in income, which is offset by 1.4 billion in interest expense. So net, they gain nearly $2 billion from interest earnings. Then lots of fees and commissions, a bit less than that. Again, they have to spend money on fees and commissions. For example, I mentioned the payments. They have to pay fees to other banks and services. So that's included there. So you'll see a net fee and commission income. Net trading income, and this is trading that they do on their own account and also trading that they do for their customers. Again, this is a big money center bank. You wouldn't see this line on a community bank, or not this kind of value. And then a couple of other bits and pieces. So total revenue of 4.1 billion. And of that, nearly 2 billion, nearly a half, is net interest income. And then a bunch more on fees. For a community bank where you don't have the trading income, the percentages are even higher. Then they got a bunch of other things under their gross revenue, other income, which is relatively small. They will offset it by their loan losses or their anticipated loan losses. So as soon as they think there's a good chance they won't get paid back on a loan, they have to book that as an expected loss. And that hits their income statement right away, rather than waiting till the loss is actually incurred. And then you see personnel expenses. operating leases, depreciation, other expenses. The other expenses would include computer expenses other than personnel. So IT personnel would be in there, and their computer leasing and all that kind of thing would be in these amounts. So often they won't go into very much detail. If you ever want to know more detail and you want to look at a bank's financial statements, the trick is then to follow these footnotes. So they'll always show this is the footnote that explains and breaks down these numbers. This just gives a sort of a high-level picture of their income and expense. This is fairly straightforward. The balance sheet isn't quite so simple. And the balance sheet is very, very important. Depending on how much you know about accounting, this may be more or less basic, what I say. But the balance sheet has two sides, but really three sections. On one side are the assets. These are things we have or things that we are owed. So we have cash. It's sitting in a bank account somewhere at a different bank. Okay. We have some assets that have been pledged to us or lent to us or given to, not lent to us, that belong to us, that are actually sitting somewhere else that we can demand back at any time. We have loans and advances. And advances are very similar to loans. They behave a bit differently. But loans and advances made to other banks. And again, this is a big bank, but this can be true of any size bank. And loans and advances to customers. And you can see of the total 97 billion in assets, 63 billion plus another 5 to bank, 68 billion are loans. So the majority of the asset base of a bank is in the money that it's lent to other parties that it expects to get back. And generally these are, the way these are recorded is the current book value of loans, which takes into account expected losses. So they're reduced by the amount of expected losses. In this case, they own some investments, some securities, property and equipment, fixed assets, in other words, and so on. And the others don't really need to be gone into particularly. Notice again, there's footnotes for all of these, as well as explanations on that page. So you can always dig deeper. The other side of the balance sheet has two sections to it. So we've talked about what it is we have. Now we go into what it is we owe. So what's in our possession that doesn't really belong to us? And of course, the obvious one of those is deposits from customers. And it could be deposits from banks. It could be other forms of money in which we essentially have received money in exchange for a promise to pay it back. So that's what debt securities really are like. It's really another form of taking deposits, except that we're going to pay interest on it. It's a loan we've received, in effect. And then there's a few other things that you'll see on balance sheets that you don't have to worry too much about. But as you can see, of the 90 billion in liabilities, so a liability is something we are liable to make good to somebody else, something we owe or something we promised to make good. Of the 90 billion, 76 billion, nearly all of it, is actually in deposits and loans that we've taken from other banks. So now you'll see a difference. The assets, what we have is 97 billion. The liabilities, what we owe is 90 billion. And the difference is the net value of the organization, the equity. This is really what we're worth, what the organization is worth. So that's $6 billion difference, or 6 billion euro difference in this case, is made up of share capital. So this is what investors have put into the bank, and this is a public bank, much bigger numbers than you'd see in a private bank. Retained earnings, so this is where we have earned more than we've spent. in previous years. We built that up and we added to it this year because we made a profit this year. And then reserves, which are really retained earnings, but they're set aside for particular purposes. And that equity is what's looked at very closely to see if the bank has a buffer. So if the bank goes through a really bad time and starts losing money year on year, it's going to draw on this equity. It's going to draw on the reserves first, probably. The retained earnings then get drained down, and eventually the share capital is worth less and less over time. But generally, a bank, of course, doesn't expect to go there and doesn't want to go there. But mostly what I wanted to do was explain these terms, assets, liabilities, and equity, because they're really important when talking about banks. And banks often talk about the size of their balance sheet. So the size of this bank's balance sheet is $97 billion. And you'll notice that assets equals liabilities plus equity. That's always true. That's the balance in a balance sheet. A big money center bank has a balance sheet in the tens of billions or hundreds of billions even. A regional bank typically is around the 50 billion or something like that. And a community bank is everything from 5 billion or so, one or two a little bit higher than that, let's say 10 billion, down to as little as 10 million. 10 million is a very small bank, and there's not very much that you could do with that, but it has a very specific purpose typically. So, so asset size is really the way in which people generally measure the size of a bank. Okay, I'm going to pause there and see if we have questions.
There are none in the chat, but does anyone have any questions right now?
So let me ask if because I can't see facial expressions, am I making sense? Is this helpful?
This is great.
Yes, I agree.
Okay, good.
Yep, comments in the chat also agree.
All right. Okay, let's go into the biggest things banks do, which is lending money. And the deposit services and so on are important. They aren't as complex as making loans is. So I thought I'd create a little bit of a flow here, and good to have a picture rather than lots of bullets, although it's got lots of bullets in it, and talk about the life cycle of a loan. And there's lots of different kinds of loan, like consumer real estate or working capital for a business or leasing or construction loans and so on. They really all have these same stages, these same phases. And so if you've got this, you've got an overall picture of what lending is about. So we'll spend a few minutes on this. Not surprisingly, it starts out with sales. Somehow or other, the bank has to find somebody who wants to borrow money from them. And they'll, as you would expect, they'll use advertising of various different kinds. They'll make offers. We are all absolutely sick of consumer real estate refinancing advertisements on television and so on. That's basically what it is. That's, in many cases, they're not banks actually, but it's the same idea. Once somebody says, yes, I'm interested in a loan, then the sales process goes into verifying identity, and there are regulations that require them to do that. Go through a pre-approval process. So I'll ask some basic questions, maybe run a quick credit check, maybe have a quick look at what kind of collateral there is. Collateral, so in a consumer real estate loan, collateral is your house. It's what the bank will fall back on if you default on your loan. So they will take ownership of the collateral. And there's lots of different kinds of it. We'll talk a little bit more about that later. And then they'll start the documentation process. And the loan then, assuming all looks okay, it will go into underwriting. And you may have heard the term underwriting in relation to insurance, and it's more common there. At least that's where I heard it first. But it really is the same thing. It's assessing what kind of risk there is to the bank if it's going to make this loan. And so there's all sorts of things that they need to look at, especially for commercial lending. They'll look at how solid the collateral is and how stable the value is going to be. They'll look at the borrower. Are they going to be able to make payments? Do they have the income flow that's necessary to make payments? Do they have people who can back them, who can guarantee their loans, for example? They'll look at credit history and various other things. Nowadays they will do social media searches and various other ways of finding out whatever they can about the borrower. They'll look at the business they're in and say, is this a stable business? Is this a business that's very high risk? Like, for example, commercial real estate is a very high risk business. Investment in bare land intended for development is extremely high risk. And so they'll adjust various things. They'll adjust the amount of collateral they require, and they'll adjust how they price a loan. And pricing a loan means setting the interest rate, determining how long the loan can be for, determining what upfront charges they're going to make, and things like that, deciding on what they need in the way of guarantees and everything else. So a lot goes into pricing. And the whole purpose of pricing, from the bank's point of view, is to ensure that it's managing the risk in a way that means in the aggregate, it will make more money than it loses from its lending activities. Obviously, the opposite would not be a very good practice for a bank. Wouldn't last long. So they know that they will lose money on some loans. They don't know which ones. If they did, they just wouldn't make them. And so they're playing probabilities. They're doing risk management. And the next session, I'm going to talk a lot more about risk management. So I'm not going to cover it here. But so underwriting is all of those things. In the underwriting, then they will define what the collateral has to be. So again, using the example of residential real estate or consumer real estate, when you take out a mortgage, one of the things the bank will insist on doing is getting an independent valuation of your property. You can say that your property is worth $1 million and therefore you want to borrow 950,000. And the bank will say a number of things. First of all, we want to prove to ourselves that it's worth $1 million. So they'll have their appraiser that they use, and their appraiser may come back and say, yeah, it's worth $1 million. And then secondly, they'll say, well, you're in an area which has fluctuating residential values, and it may be worth $1 million today, but it may only be worth 900,000 tomorrow. So if I lend you 950,000, then you're going to be underwater, and I don't want a loan that's going to get underwater. So they may say, I'll only lend you up to 900,000 because I want a cushion. And so all sorts of things like that go into underwriting. At the end of the underwriting cycle, then the documentation that we talked about under sales gets finished off. And there's tons and tons of documents, and you've seen that. If you've ever taken out a mortgage, you've been appalled at how much documentation you have to sign, right? And particularly if you try and read it, it's full of legalese. And the escrow officer, I'm not going to go into escrow, but the escrow officer will say, well, have you read all that? And your eyes have glazed over at that point, and so you say yes. Every clause in every one of those documents has a lawsuit behind it. Every clause results from the fact that somebody sued a bank for not covering some remote possibility. And so they cover them all. Anything that could possibly go wrong, they try and cover in those loan documents. Included in that is you sign over the collateral to the bank in terms of what's called title. Even though you continue to live in your house, as you know, the bank actually owns the title to your house until such time as you've paid off the loan, and then the bank releases title back to you. So all sorts of stuff like that. If you've got guarantors for a loan, they have to sign all sorts of stuff, saying that they will make good on the loan if you default. Banks, by the way, have a terribly hard time collecting on guarantees, so they don't generally like them, but they will sometimes insist on them. And so all of that then gets finished, and you go into servicing. The servicing department then is keeping track of the loan on a month-by-month basis. They're making sure that you're paying. If you're late, they'll let you know you're late, and they'll start charging you late fees. If you miss payments, then they'll let you know about it, but also they have to start doing accounting differently. If you miss 2 or 3 payments, then they have to start writing down the value of the loan on their books and calling them bad loans from an accounting point of view. Doesn't mean they've given up on them, but it means they now have to accept the possibility they may not get all their principal back. All of that happens in servicing. And then there's a whole bunch of regulatory reporting they have to do, and internal reporting and everything else. Ultimately, if a loan really does go bad and it becomes apparent that the borrower isn't going to pay, then they go into collections. Banks sometimes use external agencies for collections. If you think of a money lender, money lenders are notorious for using very unscrupulous collections agencies, and sometimes violence can ensue. Banks don't do that. No regulated bank in the US does that. But still, it can be very unpleasant to be hounded by a collections agency, and eventually it yields some fruit. So that's why banks sometimes use them. Some banks do their own collections. Ultimately, though, they're going to get their money, or they're going to take ownership of the collateral. And so when they foreclose, they're basically saying, okay, the collateral is now ours. It's a legal process. And a court basically approves the formal transfer of title. And the bank now owns the property. And we've seen all sorts of stories about how that works. It's usually not very friendly to the occupiers of that property, and it can be very unpleasant. Banks sometimes, sorry, yes, go ahead.
We have a question in the chat, and then I just also want to do a time check. It's 7:53.
Oh yeah.
But the question in the chat is, when someone was trying to refinance a loan, the loan officer kept talking about the underwriters as if they were a totally separate group from the bank. Are underwriters a separate entity, or are they a department within the bank?
They're generally a department within the bank. If the refinancing isn't being done by a bank, though, sometimes you get sort of fronting organizations like loan brokers are doing all the sales stuff, but the underwriting then is going to be at the actual lender. So that's maybe why they talk that way. But for a bank, they're part of the bank. Good question. All right, and I'm going to wrap this up. There isn't too much more after this, actually. At maturity, then the bank will say, okay, this is the last payment. Here's how much you owe. Or if a borrower wants to pay early, then a payoff statement will be given by the bank to the borrower, and then they will release all of the collateral. And the bank then is finished. It's done with it. I mentioned foreclosure, a lot of legal processes. The biggest headache actually for banks around foreclosure, other than the legal processes, which can be a nightmare, especially in commercial lending, the biggest issue is then they've acquired some property they never wanted. And big banks have large real estate management departments called real estate owned. And they then have to service the properties, especially commercial properties. They got to collect rents. They got to do evictions if necessary. All sorts of stuff that isn't really what the bank likes to do. And eventually they got to try and sell the properties in order to reimburse them for all the money they lost on the loan that defaulted. So there's a lot of activity there. And the key is this whole process the bank has to manage well. Just 2 other things I'll mention. Portfolio management. A bank doesn't just look at individual loans. It looks at the whole portfolio of loans. It needs it balanced. Imagine, for example, that a bank does all of its lending in one industry, like mining, and then the mining industry collapses, which someone on this call may not mind too much. Then all of those loans are going to default and the bank is going to collapse. So what a bank tries to do is spread its risk across different industry, different kinds of loan, different kinds of customer, so that it's got a balanced portfolio. And overall, it doesn't have what are called concentration risks. Same thing with geography, same thing with repayment timelines and things like that. It's a complex area. And then the other things underlying all of that, there is a comprehensive loan processing platform which tracks the loan all the way through. It's partly technology, it's partly processes and people. And that's what makes it all hang together. So lending is in many ways the most complex thing a bank does because of all those pieces.
We have a question that asks, where does redlining fall into this cycle?
Yeah, it's a really good question. I think there are two ways in which it falls in. One is the way sales is done and underwriting, perceptions of risk in underwriting. So if a bank believes that certain communities are going to be higher risk, and sometimes they are because of the economic circumstances in those communities, then the bank is less inclined to lend. There's a bit of a vicious circle, as there is with so much, for example, racial disparity and socioeconomic disparity in our country, because of systemic lack of equity and lack of access. The risks are actually higher. It's a little bit like saying, incarceration rates are higher in Black communities, which is really correlated with socioeconomic standard, educational opportunities, employment opportunities, and all sorts of things. It doesn't mean that they're really at higher risk of crime, but it is a reality that a bank has to look at. So it does tie in. At the same time, it can be offset by guarantee systems and things like SBA loan guarantees make a bank perfectly comfortable lending in what seem to be high risk areas. And so more and more reform of those guarantee systems is the way to offset some of that lack of access. It's happening to some degree. The latest round of SBA PPP loans, for example, is favoring low-income areas. And so, there's some good things, but a long, long way to go. And that's a complex question. It's a very simple answer, but probably should move on. Just fairly quickly, where does the money come from? And I've covered some of this. So banks get the money that they lend out. They get it from individuals. They get it from businesses. And this is just regular deposits and savings. They get it from government agencies. And, big banks in particular get government agency money, as we know, which is why we're here. And they get it from other financial institutions. Banks lend to banks. And there's a lot of reasons for them doing that. Shareholder capital also can be lent up to a point. They get money from capital markets, so they borrow in capital markets, and they'll issue bonds, for example, which is a debt instrument. And they also will get more equity from capital markets. Now, again, you don't see that so much in community banks, and you certainly wouldn't see that so much in public banks. When we go deeper into how this all works for a public bank, down the road a little bit, then we'll see how some of these play out. We're still trying to figure that out, I think, all of us. And then it's not actually where money comes from, but it is a way of them being able to lend more with the money they've got, is guarantees, external guarantees. And this is going to be really important to us because I'm not going to go into it. Just take my word for it. We don't really have time. I've talked about the fact that profit that comes from their interest rate spread, how much we pay to borrowers, how much borrowers pay us minus how much we have to pay to our different sources of money is where our profit comes from, the interest rate spread. And I think that'll do for that, given that we're almost out of time. Major stakeholders. I think my only point here that I want to make is a bank has to satisfy its shareholders who want profit maximized. They have to satisfy their customers who don't want to have to pay too much and want really good service. They have to satisfy the regulators who want to ensure the bank isn't taking too much risk, that all their customers are protected, which has a cost associated with it. And then banks should be, anyway, and community banks certainly take this more seriously, they have to satisfy their communities and demonstrate that they're contributing to the growth of business and looking after the environment. When we come to a public bank, it's going to have all of these things, with the community things and additional a political element being more significant than it is for a commercial bank. So this is going to be challenging, and we've talked about this a bit, I think, all of us. So a successful bank is meeting all of the expectations on it and the needs of each stakeholder without seriously damaging any of the others. And it's a balancing act. It's a very difficult balancing act that actually I think we all underestimate. I've touched on this: money center banks, regional banks, community banks, credit unions. I didn't talk about. They're not technically banks, but they behave like banks. And then things like community development finance institutions and various other special purpose entities. And then, of course, now we have public banks. In terms of market share, you can see that these big money center banks, the giant banks, account for 59% of the assets of banks. Banks and credit unions, smaller banks and credit unions account for the rest. And these large banks really are the regional banks for the most part. No surprises there, probably. Next in 2 weeks, we're going to talk about the real business of banking, which is risk management. And I'll explain that on March 9th. If we have...
Thank you very much for that very informative presentation. We have we have 2 questions. One, are the property management departments in banks open to the public to buy reduced priced properties?
Sometimes, yeah. Often what they'll do is hold auctions. Auctions are very dangerous places to buy property, of course. You really need to know what you're doing. But in principle, they're open to the public. And then sometimes they will just sell them through, some banks have their own realtors. They'll sell them through them, or they'll sell them through public realtors. But yes, generally, whatever they take as collateral when they sell them, they're open to the public, to companies, whatever.
And then the other question is, why are credit unions not considered real banks?
2 reasons. One is banks generally are either owned by the public or they're owned by shareholders. Credit unions are owned by the members, who are the depositors and usually the borrowers as well. So it's a mutual aid organization. Now, the biggest credit unions really behave like banks. But the other reason is they're regulated differently. So credit unions, for example, are tax exempt, which the banks hate. Community banks look at credit unions who behave almost exactly the same way, have the same customers and the same products, and they think it's unfair. But they're also satisfying shareholders, whereas the credit unions are really just satisfying their members. And then generally, credit unions used to be primarily consumer focused organizations. So they provided, they would have an affinity group, right? Or it could be a union or an industry or, naval veterans or whatever it is. And they would provide banking services to them. And those members would be getting the benefits of it. And they would essentially keep balanced books so that pricing is kept down. And they don't lose money, but they're not making a ton of money either. The problem is they became more and more profit-making machines, some of the very big ones, not most of them, but a handful of them. So their regulators don't demand as much of them as the bank regulators do. And that's the other thing the banks hate. But they really are very similar. They're not usually involved in capital markets, and they can't raise, I don't think they can raise money from equity markets and debt markets and so on. I'm not sure about that.
Thank you so much for that explanation. Another question is the discount window mainly used for the EOD settlement with other banks?
Yeah, it is. It is. So that's primarily what it's for. So if at the end of the day, if the settlement going on across payment systems and a bank doesn't have enough money to be able to pay its obligations, then it can borrow at the window. And that's actually really, I think, what it was primarily set up for. Great question.
And another question is, on the last pie chart, how big of a slice would you imagine public banking could have?
Pretty small. So a public bank is not likely to be, an individual public bank is not likely to be bigger than one of those medium banks, and much more likely to be in the sort of higher end of the small banks size. And bear in mind that there are nearly 10,000 small and medium banks and credit unions in America. So if we ended up with, let's say in 10 years time, there were 100 public banks that were active and growing at a reasonable rate, and I doubt it's going to be any more than that in America. It's still going to be a fairly small slice. There's specialist entities.
Awesome. Well, we've had a lot of really great questions. And does anyone else have any outstanding questions? Feel free to unmute yourself as well if anything's coming to mind. Is the 0.25% charged per day or per year?
That's per year. Yeah, it's very right now, interest rates are essentially zero. And that's intended to boost the economy. It'll stay that way for some time. There've been other times when they've been much higher than that.
Okay. That looks like all of the questions. Oh, and yes, Debbie says, thank you, Graham, for an extremely clear and helpful presentation. And I would agree, I learned a lot from this, and it was very accessible and easy for me to understand, which banking has not been for most of my life. Oh, one last question just came in. How are loans, I think it's supposed to say made. How are loans made with deposit versus equity?
It doesn't make any difference to the loan. So where the money comes from to make the loan doesn't affect the loan at all. So I mean, the point is that the bank has money that it's allowed to use from a regulatory perspective to make loans, and it will make loans from it.
Great. Well, thank you, Graham, very much for this very informative hour. Oh, Jake's still coming in. Are the deposits better?
Yeah, yes. That question. So basically, I was going to ask so originally we were thinking equity 10x, that's the loan volume, but you're saying with the deposits, you can also use that for loan volume too. So if we get deposits, like regular deposits, that also increases our loan capacity?
Absolutely. For most banks, deposits is the engine that drives lending, and that's equally true for a public bank. We have the issue with public banks about collateralization.
Yeah, I was just about to ask.
Go there another time, but they want deposits, because deposits are much cheaper than equity, or even than borrowing. So one option the bank has is to borrow at 2% and lend at 5%.
Right, and that could be for pretty much any loan, payroll, construction, bridge,
Yep.
not just mortgages and
There
water.
really isn't a connection between the source of funds and the type of loan.
Is there, what about the risk analysis for like cities? Like, let's say we wanted to help the East Bay Land Trust start buying up land. Could we start giving them 60-year loans instead of just regular 30-year loans? Is that possible? Because they're not really going to go anywhere.
Yeah, it's possible. That's where the underwriting gets really tricky because the question is how do you assess the risk? So one of the things, particularly on bare land, a commercial lender is likely to lend no more than 25% of the current appraised value of the land, as against a residential building where they might lend 80 or even 90%.
Right.
And that it's just there's a huge risk that land will become absolutely worthless. I actually worked for a commercial mortgage lender who I joined in 2007. And we had all sorts of really great loans out there that had all sorts of potential, and we just lost everything on them. So, so I kind of understand the concerns that underwriters have there. Zoe, I don't think. Oh yeah, you have recorded this. That's good. I'm happy to send the deck if you'd like to, if people would like that.
Yes, please.
Please, yeah, that'd be great.
Yeah, so you can go ahead and send that out, and then for anybody who missed it, if they'd like the deck, that's fine. Nothing proprietary in there.
Thank you, Graham. And just a reminder, in 2 weeks, Graham will be presenting again on risk management. So that will be Wednesday, March 10th, same time at 7. And yeah, thank you very much.
Okay, very welcome. Thanks, everybody. Great questions, by the way.
Thanks a lot.
Thank you. I appreciate it.
Thank you.
Have a
Yeah,
good night.
thank you so much. Oh, it's gone. That was great. Zoe, thanks so much too for organizing this. Great job.
Yeah, no problem. These are really fun, and I look forward to the whole series.
Me too. Me too. Okay.
Have a good night.
Bye.
guys.
Good night, everyone.